Thank you everyone for attending today's webinar on how do markets really work. Fountainhead does these quarterly, and we do it, these are really a deep dive into a long-term theme or a general topic on the market. And we really do this for two reasons. We want to inform our advisors, our clients, on what is going on, and we also want to inform ourselves. This really does get applied to the way we manage portfolios, the way we manage models, and so forth. For example, last quarter, we did our explorations, and our webinar topic was on declining productivity. And what we learned on that deep dive is that declining productivity really informs inflation and deflation. Declining productivity is actually a deflationary event, and the Fed really cares about it. And so that informed the later market commentary where we discussed inflation and whether inflation is transitory or structural, right? And that much longer term trend of declining productivity really touched on, that's a theme that gets a point for the transitory side of the argument. Today, we're going to discuss market structure. It's a really complex topic. It's constantly evolving. I find it really interesting. We hope that you find it really interesting too. We're fortunate to have a market structure expert with us. Also, a friend of mine knows the structure really well. So we're excited to have him on, Dave Laval. And Dave, thank you very much for joining. If you don't mind, please tell us your story.
Sure, thanks, Joe. It's really a pleasure to join Fountainhead and to be able to participate today. So I am one of those guys that finds market structure and how the markets actually work to be pretty fascinating topics. Some call me a geek on the subject, but it comes from being informed in a number of different areas and having sat in different seats that I kind of consider kind of four different legs of the ETF or the passive investment landscape. So I started my career on the floor of the American and New York Stock Exchange, which is where I met Joe 20 some years ago. Spent quite some time there building up a business before going over to NASDAQ and running NASDAQ's ETF business, where we were listing products and building trading programs for liquidity providers and trading firms. Then I shifted over to the asset management side and ran a segment of State Street Global Advisors ETF business, the Spider ETF business. I was a member of their US leadership team, and most recently was CEO of Alarian, a global indexing business. So indexing, trading, ETF regulation and exchanges, and then also asset management. And so can wear a couple of different hats as we dive into the topic, Joe. So happy to discuss whatever you feel like is the right way to go.
Excellent, thanks, Dave, and great career. We're excited to learn where you go next. But with that, while I was preparing to have you on as our featured guest, I realized I didn't understand or I didn't remember. So if it wasn't that I didn't remember, I apologize. But your position in State Street, you're a head of capital markets there on ETFs. Define for me the role, that specific role, that capital markets, like what were you there to do?
Right. So the easiest way to describe the head of capital markets or a capital markets function, a well-functioning capital markets function within an ETF business, is essentially to say everything that makes an ETF different than a mutual fund is the responsibility of the capital markets team. And so the ETF, it's like the E and the T. Everything that happens on an exchange and everything that happens related to trading the product is the simplest way to put it. And so it's the interface of what's happening in the secondary market. So the bids and the offers and trading on exchanges, the whole primary market transaction, so creation of new shares and redemption of shares is another aspect of it. And then the entire what I call liquidity ecosystem that surrounds that ETF is the responsibility of a well-functioning capital markets team to kind of manage. Trading firms, exchanges, authorized participants, all of those members of that liquidity ecosystem are really the responsibility of the capital markets team. And it's, to ensure that the products are trading efficiently, are trading effectively, and that clients are able to purchase and sell their ETFs with a high degree of confidence. And so we could whittle away at each one of those components. But the truth is to ensure that the client is having a good kind of liquidity experience buying and selling the product, and ensuring the supporting ecosystem around the product is well functioning, so that everybody is having a good experience, trading the fund.
Excellent. Thank you for that, Dave. And so I'm going to take a couple things off what you mentioned, and then I might want to go broader back onto the ETFs. But one, some of what you said, which is really interesting to me, and just to inform everybody on the call, for those who may not know, mutual fund ETFs, exchange traded funds. I commented in the exploration that they could have named it, even though it'd be very clunky, ETMF, exchange traded mutual funds. It's literally based on the same regulation.
Yeah.
There were a couple of exceptions created, which made it a real pain to get through the SEC at some point, and that's kind of cleaned up recently, right? But it's and we'll get back to that. And then there's the E in the front, right? Sure. And so when someone enters a mutual fund, anybody enters a mutual fund, they purchase that mutual fund at the end of the day at NAV, at the net asset value of the mutual fund. There's one price. Yep. Buyers and sellers get matched. Yep. And there's some net, and something happens there. ETFs have a lot of advantages. We'll get to the advantages. There's a complexity there that's a little hidden from view. There's some people, there's a statement out there that always drives me crazy, which are, ETFs are cheap and easy. I'm just doing ETFs. And it's kind of like, I'm going to ignore everything else. So what I'd like to do before even getting to that is take a step back and broaden it out for everybody. Dave, do you mind kind of taking people through even Absolutely. Go back, because of your job with NASDAQ and everything, and the index company from beginning, create an ETF for us.
Yeah, so essentially the vast majority of ETFs that come to market today come to market under the regulatory framework of the Exchange Act of 1940. The Exchange Act of 1940 was really built to bring to bring mutual funds to market. And so when, let's pretend Joe and I want to start, Joe Dave shares and create a new ETF company, the first thing we need to do is we need to get the regulatory approval to be able to create and issue products. And so what we do is we ask for exemptive relief from the SEC to be able to create products. And that exemptive relief, focus on the exemption for a moment, is exemptions from the 40 Act that make these products a little bit different than a traditional 40 Act. And without kind of getting too complex, the main ones are that these products are going to be listed and traded on an exchange, and that these products are not just going to trade once per day at net asset value, like Joe was explaining. They're going to trade throughout the course of the day, just like another equity would trade. So if I'm buying or selling Apple from 9:30 to 4 p.m. Eastern time, or if I'm buying or selling Microsoft from 9:30 to 4 Eastern time, I can also buy and sell an ETF from 9:30 to 4 Eastern time, just like another equity security. However, it's built on the framework of the traditional 1940 Act that created the opportunity for mutual funds to come to market. And so they are essentially mutual funds that are trading on an exchange. But as you kind of unpack that, there's some additional complexity. And one of the things that I think is really important to recognize is the differentiation between the primary market and the secondary market. The primary market is where there's an engagement with the fund directly, right? And so that primary market is when somebody engages directly with the mutual fund or directly with the fund complex. Every single transaction in the mutual fund happens in the primary market. If I buy a mutual fund, if an institution buys a mutual fund, if Joe buys a mutual fund, if any one of our participants on the call buys a mutual fund, you're buying it directly from the fund complex, regardless of what that mutual fund is. In an ETF construct, since you're purchasing it on an exchange, you put your order to buy 100 shares of the ABC ETF, you can put it into, your Charles Schwab account, your TD Ameritrade account, whichever account you have, or through your advisor or as an advisor, and you're kind of throwing it into the hopper on exchange, and you're going to have an experience very likely facing off with someone else in the exchange ecosystem. That exchange ecosystem is the secondary market. It's not the primary market. You're not going directly to the fund. And so liquidity or trades are happening on exchange in the secondary market. And the vast majority of trades that are occurring in ETFs are happening on that secondary market. You're never touching the fund complex in the primary market. That liquidity exchange or that buying and selling is happening in the secondary market. And it's a very efficient transfer of risk or trades. And the reason is that all of the kind of inefficiencies that happen in mutual fund construct are really limited because you're facing off with other participants in the secondary market. Joe, we can go into more granularity there, but that's really where the kind of magic of the ETF happens, is that you're able to buy and sell it on an exchange, and you're not, kind of impairing the fund in the primary market, on a daily basis with those primary market transactions.
Yeah, and so Dave, that's great, and just to distill like why that matters so much, it matters on a couple of levels, and one of them is a really, really big one. By going through this process, by having an authorized participant and market makers deal with it,
sure.
What ends up happening is the fund manager, whether it's ETF mutual fund, the fund manager is generally not purchasing it. And because of the exchange, there's a tax advantage. And so there's some tax advantage that occurs in an ETF. And we'll talk about that because the tax advantage isn't always relevant, but it's important to understand that there is one. And then the second part is that I'm trying to think, someone out there through one of the conversations we had on the institutional side, kind of broke it down nicely. I'm not sure it's a perfect analogy, but with a mutual fund, the costs are socialized. So people who buy a mutual fund at NAV at the end of the day, the portfolio manager has to go out, it's netted out, and the portfolio manager has to go out and purchase or sell. And kind of when you get behind the machine, the mutual fund manager is really finding out what the net was the next day. There's a little slippage. And then it comes down to really understanding what exposures you have in the vehicle to understand how much more slippage there may be. And that's really shared by everyone in the mutual fund. With an ETF, it's taken out of the equation, which may be better for someone in some instances who's a buy and hold player. And every person who goes on, it's individualized, at least that aspect of cost, which I don't know if you agree with that analogy or not, or those words, those terms, but go ahead.
Yeah, I think a really great thing to start with is what's one of the headlines of ETFs? They're low fee, like fees in ETFs are lower than the fees in mutual funds. And I always like to say, let's pause for a second. Fees correlate to costs, right? So fees correlate to costs. So let's take a step back and talk about the costs. And let's use a really simple example, Joe, of just like, a $10,000 investment into a mutual fund. Let's imagine for a second that this $10,000 investment into mutual fund ABC, which is very simple, S&P 500 exposure, great. So, and that's the only trade of the day. So at the end of the day, $10,000 needs to come into the fund. The portfolio manager now has $10,000 to put to work, right? So portfolio manager takes the $10,000, goes out, buys the 502 securities that are components of the S&P 500 to put that money to work, right? And so there's costs associated with those transactions that are borne by the actual mutual fund. And so whatever costs are embedded there are going to bleed out of the fund expenses. And so the next day there's $10,000 of redemptions in that mutual fund. Oh, the portfolio manager is like, well, I gotta get $10,000, right? So they're going to go out and sell $10,000 worth of that mutual fund, and then deliver the cash out to whoever was looking for that redemption. All of those transactions that are happening inside the fund, and I'm using an oversimplified example, but every day there's going to be some sort of net need to buy or net need to sell, and all those transactions are creating taxable events within the fund. So if Joe is just a buy and hold investor and just kind of put, his money into an S&P 500 fund because he just wants to ride the market, will, bear or socialize, right, those costs of buying and selling throughout the course of the day that the portfolio manager needs to kind of achieve as a result of doing his or her job of managing the inflows and outflows of the fund, right? Now, let's pause for a second. Now let's think about the ETF scenario. $10,000 comes into an ETF, trades on exchange. $10,000 for sale in ETF, trades on exchange. $10,000 to buy, trades on exchange. $10,000 to sell, trades on exchange. Portfolio manager is sitting back and just waiting for some sort of outsized call for liquidity where there's a need to create more shares or to redeem shares. And that doesn't happen as frequently, and certainly doesn't happen on a daily basis, even in the biggest ETFs that are in the marketplace. And so that, some people say, well, there's going to be some sort of taxable event. There's absolutely going to be a taxable event. But if I buy 100 shares and then sell it 3 days later, that's my taxable event. I own that as the individual investor. If an institution buys, whatever it is, $10 million of an ETF and then sells $10 million of an ETF, that taxable event happens for the institution, right? So Joe in the ETF scenario as a buy and hold investor is buying and holding his ETF. And when he chooses to sell it, he may have a taxable gain or he may have a taxable loss, right? But that's his experience, just like it's my experience to buy it, just like it's an institution's experience to buy it. And those, taxable kind of costs aren't living inside the fund. And as a result of those reduction in costs living inside the fund, the reality is the fees are lower in an ETF structure. There's also operational costs. The fact that every transaction in a mutual fund happens in the primary market, it's the fund complex's responsibility for knowing who owns it, knowing who sold it, and all of that kind of like fund ownership and clearance and trading and all of that is really borne by the secondary market, DTCC and other kind of complexes that help clear every equity trade on the exchanges that are traded on an exchange. So I like to use kind of a simple example, and sometimes that's helpful to kind of break down those costs because people are quick to say fees and ETFs are lower, and it's like, well, they are generally, but that's because the costs are lower.
Yeah, no, it's interesting, right? And you threw out a few things there. I think also from a platform standpoint, there's another element that occurred, which I think was a little bit of a function of the time, where on a Charles Schwab or TD, there's actually a cost, there's an access cost
Right.
for mutual funds that generally is not there for the ETFs.
Right.
I think that one's pretty material. The other one you kind of commented, on the accounting side, the shareholder cost, I think is pretty, like from my own knowledge of what I've spent in the past, it's relatively de minimis, because it's a dollar amount. On the other side, getting access to a platform could be quite expensive.
That's true.
I think what I want to do, because we're getting into some interesting spaces here on the ETF. I want to share 2 slides really quickly,
Sure.
Or actually 3 slides really quickly, to just kind of make a point and bring it all home on what we've been talking about, Dave. So let's see how good I am at sharing what I want to share. Okay, that was painless. So what we're looking at here, it looks like almost one line. That's the performance of 6 different products over a 3-year period. And those 6 different products are 3 ETFs and 3 mutual funds. And what we did was we paired it. So if you see on the top there, I don't know if you can follow the Schwab Total Stock Market Index, and then the Schwab US Broad Market ETF. And then you have 2 Vanguard ones. And the reason we brought Schwab into it is because Vanguard actually has a patent and this really drives home the fact that these are the same exact sort of product from a regulatory standpoint. Vanguard actually has a patent to make ETFs a share class of their mutual funds. And so they actually issue their ETFs out of their own trust. And so with Vanguard, you actually have the capability to go from one to the other without creating a tax event, which is really interesting. The bigger point here is that the performance is identical. Over this 3-year period, the performance between the fund and the ETF are identical in US large cap, and the taxes are also identical in this instance. Here, we have a cloud computing sector. Okay, so this is for those clients, and thematics have been really interesting kind of exposures that really exist only on the ETF side. And one of the reasons is, being able to go to market quickly. I'm not even going to touch the reasons why they're there. We're just going to take it as gospel that there's a reason thematics pop up on the ETF side. Dave, if you want to tackle it when we get to it, you could tackle it. But as you can see here, all 4 companies here, and the names are First Trust Cloud Computing ETF, Global X Cloud Computing ETF, Wisdom Tree Cloud Computing ETF, Wedbush ETF MG Global Cloud Tech ETF. They have almost, like 3 of them are identical names. The other one's close enough. If you as an investor decide, hey, I want to get a cloud computing exposure, here you can see there's a huge difference. We took it again. This is from when all 4 were issued. And you could see if you got into one of them, you had 120% return over the period. If you went into another, you had a 40% return. If you decided to get into the winner here, year to date, you would have lost to one of the other ones. So, you can't, right? Past performance doesn't indicate where we're going. The bigger point here, and the real point I wanted to make on this page, is that passive isn't truly passive as you start going down and become more complex in what that exposure is. In our explorations itself, we comment that one of these 4 cloud computing ETFs holds Amazon. The other 3 don't. It's amazing. From the top 10, 80% fully were unique to one or the other. So right there, you could kind of see there's interesting definitions, and you go down the slope of where you're going from passive to active.
Hey, Joe,
the last thing,
Joe,
go ahead, Dave.
Let me jump in.
Yeah.
If you can go back. The reality is I like to say not every ETF is created equally. Not every ETF issuer is created equally. Not every index is created equally. And the reason why the exposures are different is, let's pretend, right, back to Joe Dave shares. So Joe Dave shares is going to take advantage of the interest in cloud computing. If we were going to bring a product to market, we can't have it look exactly the same as the other products that are in the marketplace. We need to arm our sales team with something that's a more interesting story, with kind of a more diverse or differentiated position in the marketplace. And so you're going to see different exposures with, tackling the same, thematic, kind of opportunity in the marketplace. The reason more generally why I think thematics are becoming more and more popular is traditional, sector slices of the marketplace no longer apply to what's actually happening in our economy. And so you take a company like Amazon, well, what is it, right? Or you take a company like Tesla, what is it? Is it an automaker? Is it a technology company? It's very interesting. And so these notions of themes are becoming more and more prevalent, because you're trying to tackle kind of a pure play exposure, that's really interesting in the marketplace. One of the most kind of interesting ones to me is, the notion of space, right? And so, there's a couple of space ETFs out there. And, that was something that was not really thought of being an exposure that would be interesting. And very recently, in the past 6 months, Kathy Wood came out and said, space is going to be the next, the new frontier of kind of investing exposure, no pun intended, which got, some activity in some of the space ETFs that are out there. And that's kind of a, new frontier of thematics. And I think cloud computing is kind of a battle-tested example of a thematic.
Thanks for that. No, that's great, Dave. And you mentioned, Amazon and the whole concept of thematics, which is a great point. I didn't even think about it that much, that the world is becoming so complex, it's really hard to throw it into sectors. And the one that immediately comes to mind is Amazon. Amazon is in the consumer goods sector of the S&P. It's not considered technology. And when you look at US versus developed markets versus emerging markets, and you look at general PEs for groupings, well, consumer goods for the US looks rich on a PE level because it has Amazon in there. But when you kind of clean up, it's all the same, right? And so it becomes really hard to do these relative valuations. And then I already commented that Amazon isn't cloud computing. Well, they do cloud computing. I don't know what percentage it is. So there's arguments to say that Amazon could fall into a bunch of buckets. On the last kind of point I'll make on this ETF versus mutual fund, and we could discuss this a little bit. I mean, truthfully, we could probably discuss it all day, but we'll touch on it. You know, the items to look out for are access, cost of entry, passive versus active, which we just kind of touched on, fixed income, and taxes. Dave, I'm going to throw this to you because I have some comments on fixed income. I'm going to take the screen off. I could always pop it back if you need, but give me your sense, Dave, of fixed income, ETF versus mutual fund. I'll throw one thing out there just to, you know, of something I hear, and I don't know if you've heard this before, and I have a definitive answer of how I feel about it, at least. But we've heard over and over that you really have to do fixed income active, and there's no place for it in passive. I'm pretty positive I know where you'll go with it, but I'm going to throw it to you before we say we're probably aligned here, right? Shocker. but speak to that for a minute, because I think that's a big one out there.
Yeah. I'll get to that. I mean, when you throw up those, you know, 4 or 5 bullets, again, I'm getting all excited to talk about the different components of that. When back to my point about not every ETF is created equally, I can't tell you how many times I faced off with even institutional investors, some of the most sophisticated investors in the world, or advisor complexes, some of the most sophisticated advisor complexes say, well, I would never buy that product because it's, 14 basis points versus, your product that is, 20 basis points or vice versa, right? They're simply making a comparison on exposure based upon the cost, which is one component of your total cost of kind of an ownership in ETFs. When you're pinning a mutual fund versus a mutual fund, you can take a look at that management fee, and that management fee is really going to encompass the total cost of your ownership. When you're thinking about an ETF, you have to remember that you have a need and kind of a responsibility to purchase and sell that security in the secondary market. And so there's a cost associated with that. And the theoretical cost associated with that is the spread of the product, the bid-ask spread of the product. So you have your management fee over here, which may have a differentiation, 14 basis points on one and 20 basis points on another. So you may think, if I buy the 14 basis point product, wow, I'm going to save 6 basis points. And over time, that's maybe meaningful. But the truth of the matter is, if that 14 basis point product has a 20 basis point spread, the cost of owning it, will trump or will exceed that 20 basis point product if in fact the 20 basis point product, has a 2 basis point spread. And so you have to understand your total cost of ownership, which is going to be that management fee, right? Plus your theoretical execution cost, which is the bid-ask spread. And so when we're talking about kind of, overall ownership costs, that's a really important component to pay attention to. That's like the geek world of capital markets, to kind of circle back to our earlier conversation, really explaining total cost of ownership. And it's something that I think a lot of inexperienced ETF users don't fully appreciate, because it's a quick, okay, I want cloud computing, for example, and here are the costs of the products, and I'm going to prioritize the cheapest product. Take a look at liquidity of the product, the average daily trading volume, the average spread, bid-ask spread of the product, because those are components that are really, really important to ensuring you have kind of a seamless experience purchasing the security and then selling the security. So that's number one. When we talk about fixed income ETFs, look, the reality is fixed income ETFs have had crosshairs on them for a very long time. I've spent the vast majority of the last kind of 10 years of my career myth busting the kind of untruths that have been shared about fixed income ETFs. I think that to speak casually, they were essentially kind of being positioned as financial weapons of mass destruction that could potentially take down the fixed income markets. It's just not true. Everyone would say, well, wait till it happens, like, some sort of financial crisis, some sort of meltdown. It has happened several times. In fact, what happens is not only do the fixed income ETFs behave as designed, you see liquidity profiles of the fixed income ETF increase, you see liquidity increase, you see more participants of the marketplace turning to the ETFs for liquidity. And honestly, in some of my conversations with regulatory agencies, that would be the SEC, that would be the Fed, that would be the Department of Treasury. Some of what actually is being presented by the data is that fixed income ETFs are actually this perfect cross section of an antiquated fixed income market and kind of the new world of very active trading markets in equity. So let me pause and break that down a little bit. Fixed income markets, dealer driven, voice brokered, not a centralized tape. So I might buy one bond at 95 and turn around and see it trade at 90 and then turn around and see it trade at 100 because it depends on the broker that I call, it depends on the desk that I call, and it's a very disjointed, very segmented marketplace versus the equity markets that are trading very fast, have centralized tape. The quote is what the quote is. And so that if I'm buying it on one exchange and getting $92, I'm going to sell it on another exchange or buy it on another exchange for the exact same price because the quotes are all tied together. So what fixed income ETFs have done is this really unique cross section of, okay, so I have this kind of voice brokered exposure that's trading in the equity markets. When things get complex or things get a little dicey in the fixed income market, or things get a little bit volatile in the fixed income market, what happens in the actual cash bond trading market? People aren't obligated to pick the phones up, right? And that's only been exacerbated because post-financial crisis, banks' ability to have a large amount of their balance sheet committed to actually holding bond inventory has been decreased. So not only do they not want to pick the phone up, they can't really pick the phone up because they don't have the cash to actually warehouse the bonds. So what happens? People go to the ETF market. Why? Because they know they're going to be able to have kind of an automated experience of being able to buy and sell exposure for their bond positions. And so there's this talk about, when things get a little bit choppy in the fixed income market, ETFs are trading at a discount to the bonds, and this is not efficient. In fact, it's the most efficient experience of trading bonds there's ever been in the history of bond trading. Why? Because risk is actually transferring at the price that the bond would be trading at, just in the form of an ETF. Just because the bond is trading at 95, and the last time it traded at 95 in the fixed income markets, and they haven't traded in 5 days because people aren't picking the phones up, and the ETF would have that bond trading at, let's just say 92 or 91, there's a perceived discount to that trading value, but the reality is that's where risk is clearing. And if you had called this broker who last traded at 95, they would probably be a 90 bid, right? Because they don't actually want to buy the bond. So, it's oversimplified a little bit, but the reality is that you're having an automated experience of risk being transferred in the fixed income market in the form of this ETF, right? Versus the cash bond trading that's voice brokered over here. And keep in mind, again, the vast majority of the trading, the buying and selling of that fixed income ETF is happening in ETF shares. So the portfolio manager isn't burdened by having to go into that cash bond market and find liquidity. So that's why everyone is rushing to the ETF in times of bond market stress. And the regulators are actually looking at that and saying, oh, wow, this is shining a spotlight on the inefficiency of the cash bond market because the fixed income ETFs are really performing and behaving quite smoothly. You asked,
that's great.
You asked, Joe. I gave it to you.
I know. Oh, no. But we got. I'm going to kind of take away two items there.
Yeah, sure.
First for our constituents, and first, for an investor, the really important takeaway for an investor is that there is a disconnect from NAV, which is the net asset value, from the actual value of where the ETF trades. When there's moments of dislocation, or even not moments of dislocation, just based on how much activity there is, it's something really to be cognizant of, and you want to be careful, because when there is market dislocation, there's a lot of price discovery and value discovery going on. And what Dave's talking about is the fact that ETFs are it's way easier to create a exposure during the day in a fast-moving market, or you can't even do it in a mutual fund. You could only do it in ETF. And so you get this dislocation, and I think people point to that, as Dave was saying, and saying, there, we got you. Fixed income is a broken product. Look at the spread from NAV, but the reality, as Dave said, is it's just people doing price discovery ahead of time. An investor wants to be careful there. A retail investor wants to be careful there. A retail investor also wants to be careful with spread. We had a question come in, and I recommend people, aren't ETFs just cheaper? And that's what, and thank you for the question, and that's what Dave's really talking about here, which is you're not getting it at NAV. So, we had a product, by the way, in our practice we looked at, right? And when you think about how market structure is incorporated within our practice, right, of managing portfolios on behalf of our clients, on behalf of our advisors, we look at what the exposure is, what the risk reward of the underlying exposure is. We look at the process of the manager, whether active or passive, right? And cloud computing is that perfect example. It's passive. We just have cloud computing exposure. What's the big deal? You have to look deeper than that and really understand it. Then we look at liquidity, right? We had a product, we really liked the product. It didn't have the liquidity until recently to actually trade it. Now, if you're institutional, you could go and you could call up an AP, you could call up a market maker and say, this is where I want to do things. So if you're a large player who's going to participate once in a while with very large tickets, great. We don't have that luxury. We have over 2,000 accounts that we manage. Money's coming in and out all the time. I need to be able to trade $100 worth of something. Right? We may trade a few million in a rebalance, but we may trade $100 for someone. We need efficient pricing for that $100 trades. We care about the $100 trades, everybody. We really do. So you have liquidity. And then you also, by the way, have liquidity for the underlying exposure, right? And that's another thing Dave's talking about, and I'll come back to fixed income in a minute. But when the markets go bad, what's going to happen? And I'm going to put words in Dave's mouth because I think I heard it, but the way equities are set up is materially better than the way fixed income is set up. It's a structural thing. FinTech's getting us there, I think. It's going to be a long way off. Part of the problem is that there's so many CUSIPs, and so you just don't have liquidity, but it's problematic. And then appropriate structure. And this is a really big one because we've discussed ETFs and mutual funds. We sometimes do, which has become kind of interval funds has become kind of a hot structure out there. They're trying to get the middle between giving some liquidity. They give generally quarterly 5% liquidity to their constituents, daily liquidity to enter. You have private funds, and there's some products that just cannot be placed into an ETF or mutual fund structure. And if it is, to us, it's problematic. And the example would be, you put someone, a bunch of houses, real estate, retail real estate in it. You can't get in and out of that. So you just need huge cash buffers and other proxies. You want to make that product more, less liquid. And so, just kind of bringing it back to the second point I wanted to make on fixed income, the other big kind of, because I agree with you. I think ETFs and mutual funds from a fixed income standpoint, you could do either or, you could do passive, you could do active. One of them is the fact that it's so over the counter. Everybody's just going to run ahead of the passive ETF and pick up whatever's there. And then another complaint is that, the largest managers in the world, BlackRock, et cetera, just have better access. APs have grown up, market makers have grown up. They all have that access. When you think about, and I've actually done a creation into a fixed income ETF, you actually get a selection. They may have like 300 securities in there, and they make you pick from each bucket. So there's actually a lot more liquidity than people recognize to go in and out. And on a daily basis, the manager could adjust that. So it really is dynamic. The things you really want to look out for on an ETF is that, just like the question, was, cost of entry, fees and spreads, what's really passive, what's really active, and then taxes, when it matters, when it doesn't. Because in a lot of products, if you're in a qualified account, who cares about taxes, right? Daily liquidity, you care about the whole cost in. We're not trading in and out. We're not, day traders. So I want to, we're running out of time. I want to touch on 2 or 3 topics. So first, I just want to touch on cryptos. Why hasn't crypto's gotten, how come there's no crypto ETF
Yeah.
in the marketplace?
So in 2011, 2012, when I was at NASDAQ, I sat across the table from the Winklevoss twins, and they had hired really high quality 40 Act counsel. In fact, the 40 Act counsel that brought the first gold ETF, physical backed gold ETF to market. And we were having a meeting to talk about kind of bringing a crypto ETF. So it's like 9 years ago now. There still hasn't been one. At the end of the day, I don't think it's a question of if, I just think it's a matter of when. And, what is principally, I would say what's critically important to, the regulators that I've ever talked to about bringing any novel new product to market is to ensure that that secondary market trading on exchange does not decouple from the intrinsic value of the product for a persistent period of time. And so in the cash equity markets and the US cash equity markets, it's pretty clear that the US cash equity markets are quite efficient in trading. And so that net asset value, or the kind of intraday net asset value, is always going to be tied very, very, very closely to the price of the ETF, right? And as you get to more esoteric markets, or you get to more novel products, that can be more of a concern to regulatory agencies. And I think in the case of crypto, again, it's not a question of, if, it's a question of when the regulators will get comfortable that, there's efficiency in the underlying market in a way that will allow for investors to buy and sell the ETF for that exposure with a high degree of confidence, and in a way that there isn't going to be kind of a wild kind of decoupling from the intrinsic value of the underlying security. So it's really I believe, in my opinion, regulators getting comfortable with the underlying exposure and some of the mechanics of the underlying marketplace. But I think it's on the horizon.
Yeah, no, that's a great answer. And I think I'll just add to it. I think, institutional infrastructure, right? The ability to hold these things in the appropriate places and trust and all that, the pipes, all those things really matter. So it's not terrible to be conservative. If you think about 2x leverage products, which came out at some point, it probably got out a little too quick. It kind of blew up some of the access things. It used to be an automatic every ETF everywhere, and that blew that up. And then people used to think, okay, I have 2x of the S&P, great, I get 2x up, 2x down. It's only daily. And so if you have a lot of volatility, you can really get annihilated in those products. So while you were, we have another question, and we're finishing up. We got another one or two topics here, but anybody from the crowd who wants to throw one in. This is, I thought there were Bitcoin ETFs. Why do you say there are none? So there's a lot of blockchain. I think people try to be really savvy in marketing. I mean, there's a real element of retail in ETFs. Not to knock on retail, but what ends up happening is that these issuers will try to, they couldn't get the crypto in there, so they're trying to create this whole ecosystem around it. And listen, a blockchain ETF can be great if that's the exposure you want. But we've heard that a few times where it's like, hey, I know there's a crypto ETF. I saw it. I saw an advertisement for it. There's no crypto ETFs. It's not allowed yet. It's just the ecosystem around it. In the U.S. market, that's right. We have one in Toronto.
There's a couple in Canada.
In Canada. So if you could access international. But in the U.S. market, they quite haven't gone there. So Dave, while you were talking, before, I went online and I got an LLC. I called it Dave Joe Shares instead of Joe Dave. So I'm deferring to you.
Sure.
You've been at the NASDAQ. You spoke to the Winklevoss twins. You were recently the CEO of an index company. You get all the innovation coming in. That's why I put you first, because you're going to have to come up with the ideas. I'll just sit here in the background. What do you see coming to the market next? Like, talk to us a little bit about innovation within market structure, because market structure is constantly evolving, and even innovation within that ETF space.
I'll say a couple of things. The world, so you've said a couple of times, active versus passive. I think you're going to see a shift from this active versus passive debate to active and passive. I think that you're going to look at passive products being used for active allocations. I mean, look, Fountainhead is a great example of you guys utilizing ETFs to build different models and different exposures with a great deal of efficiency. I think you're going to see a broader adoption of fixed income ETFs, both active and passive. I think over the past couple of years, there has been some tremendous innovation in the regulatory framework around exchange traded funds and the exchange traded fund marketplace. And what that has done is really leveled the playing field. So that exemptive relief that I talked about in the beginning of our conversation, every firm's exemptive relief had some, little bits and pieces of nuances, and those that got into the marketplace earlier may have had some more flexibility than those that got into the marketplace later. Largely, there's now a level playing field from an exemptive relief perspective, and that's going to open up the opportunity for more players to get involved in fixed income ETF issuance. That includes current ETF issuers with kind of well-established franchises, and that also includes well-established asset managers that have not yet gotten into the ETF fray. And so I think there's going to be more products that come to market. I think the innovation is going to be in the sense that different types of portfolio management and different exposures are going to be brought to market in the form of an ETF wrapper. And I think that there will be a continuation of thematic exposures. And I think that, themes like, let's just say, automation and robotics, for example, right? Used to be a theme, right? I think the themes are going to be chopped up into much smaller pieces. For example, AI would be something that was a sleeve within automation and robotics, and now it's going to have the potential to be its own product. And I think this notion of thematics expanding, thematic products, more thematic products coming to market, the range of the exposure and the theme getting narrower. And I think you're going to see fixed income ETFs come to market as well. And I also think that there are a lot of firms out there that are chasing the ultimate goal of getting some sort of cryptocurrency, physically backed cryptocurrency product into the marketplace. So that's what I see.
Yeah.
And,
That's awesome. That's awesome. Thank you. And it basically what it comes down to is just a sharper point on what exposures you can have, and ETFs providing that capability. The last item I want to touch on really quickly, and then see if there's any remaining questions, because we're getting long here on time. And it's probably the most important one. We probably should have done it all the way in the beginning. We'll have to do a redo here. Is market structure concerns.
Sure.
I'm going to throw out two really quick high level, and I'll let you kind of, go from there. You bought one of them up, which is fixed income concerns.
Yep.
When COVID hit the market, March, some of why it was so violent is that the fixed income market totally broke. It literally broke. You couldn't do a thing. Dave, you touched on it earlier with your comments that based on regulation, some of it that came out due to 2008, banks were tied in that they could not, they simply couldn't take on inventory. I've been thinking about this a lot lately. You started as a market maker. You started on the chain. I started as a market maker. The liquidity that's afforded to market makers has declined dramatically. The benefit of doing it has declined, which creates wider markets and more issues for it. Ultimately, the government had to step in and backdrop more or less the whole fixed income structure for it not to have been so much more disastrous. So I want your opinions on that. The other one I'm going to throw out really quick, and we could get them both in the same breath, is items like Robinhood.
Right.
Right. And Robinhood, 70%, 75 to 80% of Robinhood revenues come from selling their order flow. We had a conversation at some point offline about this, listen, over the last 30 years, fees have come down dramatically. That's awesome. And even with Robinhood, it's come down, but now they're not transparent. How much are you paying? And you've spoken a lot about spread.
Yep.
Right. What's the spread when you're selling it? So Robinhood kind of concerns me in some of where it goes and what it does from a transparency, from a cost, and ultimately an unwind, what that looks like.
Yeah.
So I'll leave it to you to end on this final question, unless we have any questions from the audience.
Yeah, so I'll start with on the fixed income side. When just one more vote for fixed income ETFs. When the government decided to come in and prop up the fixed income market, where did they go, Joe? They bought fixed income ETFs. Yeah. Right? Why? It was the most efficient way for them to come into the marketplace, right? They hired a manager to kind of execute trades on their behalf, and then they got in a smooth fashion, and then they ultimately got out in a smooth fashion. I don't know if they're totally out, but I know they were liquidating their positions. But yes, in terms of innovations in market structure, I think, as I like to say, if you have like that old school tuner, you've got the big dial over here, and then like in terms of the equity markets, like the innovations we're doing in equity market structure, we're turning the tiniest dial like 1 and 2 degrees. In the fixed income market, we've got the big dial, and we can make some pretty significant adjustments in terms of a centralized tape and in terms of fully transparent, kind of execution and a shared tape and a shared quote blotter. There's a lot we can do in terms of automating the fixed income market, and I think that's something that is going to attract some attention in the future. As it pertains to kind of Robinhood and selling order flow, and there's been a lot of talk about flash boys and the markets are rigged, and like all of those kind of things. That's something that I've been hearing and kind of talking about for a very long time, and upwards of kind of the past 10 years. And the truth of the matter is when Reg NMS came into play in 2005-ish, Joe, you and I were both on the floor of the American Stock Exchange at that point in time. That was the first kind of regulatory innovation since 1975. And so that was the opportunity for the markets to become...
Explain Reg NMS just briefly,
just
so people know.
Yeah, so that was essentially, I can oversimplify, I don't know, it was like a 400-page document that came out of the SEC into 2 statements. For you to be a recognized exchange in the national market system, NMS, Reg NMS, national market system, you had to be an immediate and automated market center. Immediate, meaning that you had sub-second execution, and automated, meaning you would execute without human intervention. And so that, dynamically changed, the marketplace. And in 1975, it was the ITS, the intermarket trading system, that was brought in place, that was to telephonically connect the regional exchanges. So Cincinnati and the Pacific Coast and Philadelphia, Chicago, Amex, New York. And so, that was like the modern innovation. In the late 90s, I always use this example, I had, 10 odd lot positions that my grandfather had gifted me, and it cost me $75 per trade. It was like a significant component of the value of my positions was going into executing in kind of a discount, retail brokerage firm that I had my shares with. So $75 per trade, and now we've gotten to a place where it's essentially free, right? And so again, fees are associated and correlate to costs. And so the reason why those fees have come down is because the costs and the burdens of those brokers to execute trades on your behalf has drastically been reduced. It's been reduced because there's more competition in the marketplace, there's more transparency in the marketplace, there are more brokers competing to trade, and that transparency has led to a much higher quality of execution, for individual retail investors. In fact, I think if you were to bring someone who is managing order flow for a very large retail house, and somebody who is managing order flow for the largest institution in the world, the institutional trader would tell you the retail has the greatest shake in the marketplace. And I have yet to have been told, and I've challenged people, in what industry does the retail consumer have a better experience than the institutional consumer or the wholesale consumer? I mean, milk, bread, cereal, books. I mean, if you buy wholesale, your per unit cost is cheaper as a wholesale consumer than it is as a retail consumer, right? The price you pay for whatever you're buying in the grocery store is more than the price the grocery store paid for it. And it's almost inverse in the kind of equity markets from an execution cost perspective, because it's free for a retail investor. So that's not to say there isn't a potential for structural complexities that are embedded in it being free. And I think some of that we saw when the markets got pretty wild with some of these meme stocks, where people were, very animated about not being able to continue to buy and sell some of these meme stocks on platforms like Robinhood, but that they could in kind of an institutional. Well, look, understanding precisely how that works, it was a result of collateral needing to be posted to DTCC like every other broker, right? And once Robinhood kind of settled that and kind of met their obligation, then, people were able, they as a broker dealer were able to, continue to execute in those securities. So it is complex. It's not a simple topic. I love talking about it. And before I turn it back over to Joe, I just want to say, Joe and I have known each other for a long time, but Joe is absolutely, bar none, the number one guy that I turn to for expertise when it comes to investment exposure, comes to anything kind of exotic in the marketplace as it pertains to exposure. And so it really has been an honor to be asked to participate here. And so, Joe, I just want to say thanks before I turn it back over to you.
Excellent, Dave. I really appreciate that. Thank you for that, and thank you for participating today. It was a great conversation. I'm going to put up let's see if I get this right. The thank you for joining us. The real takeaway, and Dave said it right at the end, is structure is really complex. It's nuanced. It's ever changing. Even if you think about that Robinhood, conversation and like how that informs the market, how it moves the market, how they deal with options. So complex, nuanced, ever changing, and we really, really care about it. We care about it, as commented, the $100 trade, the $1 million trade. It matters, and it informs us all. So once again, thank you so much, Dave, for having this conversation with us. Thank you, everybody, for attending, and have just a terrific day. This concludes the webinar.